All right, back for week 2 of work in progress, which, as a reminder, these are recaps of our internal discussion forums at Variant. We just want to bring folks sort of into the fold a little bit on how we operate and build theses internally. One of our discussion forums today was around tokenizing funds that exist off-chain and leveraging on-chain rails to improve access to capital, liquidity, and a lot more. Um, I think we've started to see sort of a number of these emerge already with some of the net new funds that exist on chain, like Athena. And Athena has very clearly been successful. We're starting to see a wave of more traditional funds that are also looking to go on chain. And one way that we started with thinking about how to sort of structure our analyses and theses around this category is with almost like a spectrum or a framework of two different sides of the market or two very different approaches. Jack, I feel like you were pretty articulate on this. So do you maybe want to lay out a little bit of the framework that we started to discuss?
Yeah, sure. You can kind of break it into two buckets. One is more of like the degen crypto native, like sort of fund or asset on chain. And others like leans more compliant. And like the crypto native one is, it looks a lot like Athena, where you pool capital into like an asset on chain, pump it throughout DeFi, and like generate some yield probably off chain. And we've seen a number of these things. I mean, Athena is like the most popular today, but this is largely what Lido did with like coordinating a staking network on the back end. And so that's kind of one. And then the other is like more of a compliant approach of taking funds that are off chain, have some sort of compliant requirement, and then bringing them on chain. You see this with like BlackRock's fund and a couple of other experiments there. It remains to be seen how that plays out over like a longer timeline with a lot of regulations, but anyway, that's like high level.
I almost think of the degen approach as like bottoms up in that it starts more grassroots. There's still a very dedicated strategy behind it, but it says we're just going to go direct to users and start to offer them access to differentiated returns or yield, something that they couldn't get before. Whereas I guess we're calling it the more compliant approach, but the more skeuomorphic approach of taking funds that already exist and saying, let's grow our AUM by going on chain, is more sort of top down and looking at like the world as it exists today. Whereas the bottoms up is like what's net new that can be built. Jack or Dan, whichever one of you wants to take this one, what are sort of the pros and cons of each approach?
Yeah, I think like pros of the more degen crypto native one is that it's frictionless and you can easily bootstrap a large amount of capital in a short period of time. And you saw this happen with Athena. We saw Lido do this a long time ago. And we see it now with newer stablecoins like USD AI. You can just bootstrap the supply side of like some trade that you're conducting somewhere and just like raise a ton of money to go experiment with filling some gap in the economy. And like that's really like a huge edge that you only get from permissionless finance on chain. The compliance structure or like the more skeuomorphic one, I mean that just if you can execute on it, it just opens a massive door to like basically every asset class that exists off chain and like piping that into the users on chain, which is just like an enormous amount of capital, like an enormous market.
I think that the really interesting question is going to be how these two intersect. Like we've consistently seen in crypto projects that start with the degen route and button up over time, particularly in this administration, right? We have Tether, we have Polymarket, we have the list, honestly, goes on and on. The key question that I don't yet have a good answer for is like I think like right now in this environment, like the clear answer is if you want to like move very quickly, the degen approach is of course the more fluid one, right? It's just as you said, it's more frictionless. The question is how do you parlay that back into the compliant approach? I mean, obviously, what do you go with the compliant approach? You get access to the US, and which is obviously the largest market. And you get access to more core retail, which is obviously where most of the money comes from. And if anyone watching this has a comprehensive thoughts on how you can use a moat in the degen approach and barrel back for the compliant approach, would love to hear from you.
Just riffing on that for a sec, it is really interesting to think that today they are two very different ends of the spectrum, but you probably will see both converge over time to some midpoint where, Dan, to your point, the more crypto native or sort of the more bottoms up approach goes in and becomes more compliant later, and maybe some of the compliance regulations change over time to accommodate it. Similarly, maybe you see the buttoned up top down firms become more sort of permissionless or free flowing over time as well. And I think it's a really interesting question. Where do they meet in the middle? And
Well,
actually meet all the way in the middle.
Jack had some amazing comments of that in discussion forum about how they're already intersecting and could do some more. So why don't you take that, Jack?
Yeah, to some extent, we do see like some sort of crypto funds trying to tap into the permissionless capital formation on chain just to increase their AUM by like issuing some sort of token and giving yield on chain, pursuing the DeFi integrations playbook. It's certainly far from like, the largest US regulatory institutions doing this, but it's like the incentives are obvious, which is that you just increase your AUM as a fund manager. And
like what's an example of that? Like a public example? Like what you mean, like BlackRock or something, or?
No, it's like more of a like funds running certain like trades or strategies that are like tokenizing yet. I don't think there's too many live yet, but there are some funds like considering doing something like this and taking an existing strategy that's working with like a normal LP structure and then just issuing a token on chain to like raise additional money from people on chain, from like permissionlessly, like just from like the on chain economy.
I think like we can name the big, like Athena is basically doing this, right? Like Athena is like an example of the crypto native approach, right? Where it's basis trade permissionlessly, you can get access to that strategy, right?
Yeah, exactly. It's like when Athena started with raising money on chain, but this would be funds that have like LPs that are also then coming on chain. Oh, this is an additional venue. Like we'll just do that as well.
Right. Got it.
Just to recap, there's the bottoms up sort of crypto native, what we're endearingly calling the degen approach. And then there's the other side, which is more top down, compliant. It's taking largely existing funds that exist or that want to comply with existing regulations like to a T and saying, can we open up those and provide access to capital, or can we make them more liquid almost? Jack, what do you think? Are we on the lookout for both? Do we like one more than the other? How would you sort of summarize where we got in discussion forum?
I think it's TBD, but definitely the compliant approach is really hard because like we don't know how these regulations are going to play out. Like there's a lot of ambiguity here. I think for now, like it's just you can execute much more tangibly on the kind of like more degen or crypto native approach, amassing AUM, and then trying to back into something that's compliant and starting there is probably a more interesting playbook, but still interested in people that are thinking of navigating the regulatory world and solving those hard compliance problems as they pop up.
What are you looking for in each category?
I think like for the degen one, it's like you definitely need a strong like crypto native growth playbook. And like essentially just the same frictionless flow of capital that Athena and Lido and all these have found success with. Like all these companies have had really good playbooks with regards to missions, integrations with DeFi protocol, good BD. Like I like have a lot of respect for the USDAI team and the growth playbook they're running right now. Like they just seem to, be doing that pretty well. And then on the compliance side, you need to find the right guys who are willing to chew glass and navigate like a complex regulatory regime, and really endure that for a long period of time.
How does novelty fit into this? Because obviously we're seeing many new projects that see the success of Athena and want to replicate it. So how do you view novelty in either category?
I mean, definitely for the degen approach, like everybody that's found success, like usually has like their own unique story and is bootstrapping their initial TVL and liquidity off like giving some sort of piece of that story away to their initial LPs. Like you see this with Athena's early points program. They had a really big story. Even USDI is doing the same thing.
What was the story with Athena?
Well, first off, they were the first to really do this. And they were the first to tokenize this basis trade and bring it on chain. And early on, they really leaned into like having solved a lot of the stablecoin problems, which like, with some trade-offs to some extent, they solved a lot of them. But That's a lot. And then so they were able to sell that story really well to bootstrapping AOM and getting to where they are. And I think that if you want to run that playbook, you probably need your own unique story to tell people and to bootstrap that initial class of initial liquidity.
Just sort of to wrap it up. So, Jack, I think going back to what you were saying, we're on the lookout for both. We want to see projects that are working on creating access to existing funds or maybe new fund managers, but that want to go the sort of fully compliant route and get access to global capital sources and create more liquid instruments and have them composable within DeFi. And then we're also looking for the sort of single products that want to go straight to users and start offering differentiated returns and go sort of more the bottoms up crypto native approach. But both are interesting.
I have like a related thing, which is like, so it's kind of a riff off this, but it's a different topic altogether, which is this idea that there's going to be a lot of new fund managers in the world, and that's because like crypto is really good at a couple of things. I think you guys touched on this already, which is like crypto is really good at capital formation and it's really good at access. So like pulling much money together and then giving people access to invest in new assets, and also asset creation. And so talking about one flavor of new asset, which is like funds doing these various strategies. There's all kinds of strategies you can do on chain. You could be like the best prediction markets trader, the best meme coin trader, and I'm sure there'll be like very very long tail niches that we like are difficult to imagine today in terms of new asset classes that you can be a kind of like specialized investor in. And like if you go back to like 2021, I think there was a lot of interest in democratizing investing and specifically like investment club style DAOs. We were investors in a project called Syndicate, which today is working on something completely different. Their first product was a tool to enable anyone to invest in investment clubs, right? Which is the idea that like you and your friends get together, pool some money and invest on chain. I think that's an idea that's going to come back around, and there's a good why now for it, which is that like we're starting to see the funds move on chain. Professional fund managers like Guy, the founder of Athena, perfect guy to go and do that type of project. Finance background, recognize the basis trade, saw the opportunity to bring it on chain. I think there's many more assets that are tokenized today because launching tokenized assets or launching tokens is so much easier, right? It's like pump, Doppler, whatever, really easy. In 2021, really hard. There's regulatory tailwinds, right? There's a lot more risk to launching tokens, for the last 4 years than there is at present when we have like forthcoming rulemaking. So there's gonna be a lot more tokens to invest in on-chain. And so the opportunity, I think, is like, build tools that enable this very long tail of like specialized fund managers to create strategies that people can invest in on chain. And that could take the form of copy trading, that could take the form of investment clubs or like, pooling capital in some kind of group wallet. But I think that's a really interesting design space that should be revisited now because there's a lot of tailwinds as opposed to headwinds.
Jesse, double clicking on prediction markets and sort of the emerging landscape of, you could call them quasi-fund managers there, where there are plenty of people that they're almost like influencers emerging that are seen as super forecasters in like prediction markets. And a lot of people either want to copy trade or just invest in the same things that those super forecasters are investing in. It'd be helpful to unpack like, why are emergent markets so well suited for this landscape? And so like one example, for instance, is that maybe it's just written off by larger institutional funds.
I honestly think that is the big reason, right? And I think you've seen this like in the history of like any new emerging like asset class. Like I think that, like even venture is a good example where like for a long time, like, big institutional investors wouldn't touch venture because it was too risky, right? But there was like, an emergent class of like manager that wanted to focus on that, and they scrounged capital together and they proved that like there was alpha and they generated really great returns. And then over time, more and more institutions invested. And then what happened next is like once it became an institutional asset class, and more capital was flowing into it, it became very highly specialized, and it's very long. Now there's like dedicated crypto funds like Variant, and there's dedicated biotech, and there's like, for every possible niche in technology investing, there's like a dedicated venture fund now. And so I think like, like new asset classes, like, prediction markets as a new asset class, there's an opportunity for a new fund manager to come along, not the institutional established fund manager, but some new guy who's a proven super forecaster on chain, can go raise money, maybe not from institutions at first, but from whoever he can scrounge it together from, like the people who are on chain and like, looking at the data deeply enough to know that this guy is a super forecaster. Like they can get the capital from them, and crypto uniquely enables that. And then over time, as that's proven out, like it will become more institutional, and then it will become more specialized. So that's like the life cycle of fund managers. So like back to the point I was raising earlier, like I feel like there's an opportunity to build tools that enable the first part of this process to start, right? Which is like, people who have these, these skills and these emergent asset classes, they need tools to like get the capital together, scrounge it together from those that are smart enough to see the opportunity. And neither of those parties are going to be established institutional players.
Would you rather invest in the tools or the fund managers themselves?
Yeah, that's a good question. I mean, I like probably the tools, but I'm open to both. Like we'll invest directly, we invested, for example, directly in NFTs and meme coins, and because sometimes you just want to own the asset itself. But I think it really depends on like, the facts and circumstances. But like short answer is like potentially both. Obviously, like to state the obvious, like tools, it scales better. Right. It's like a horizontal play on the trend versus like, picking one manager. So probably like that's the preference, but like I would say there's I'm open to ideas on the like creator side of the market too.
So if you're working on either of those things, hit us up. We would love to chat. And it's an area where we'll probably revisit this in another work in progress episode later on, because I think it's going to be one of the spaces that continues to, sort of evolve and change as like the landscape for these different assets and these different fund managers evolves.
Yeah. Can I have one more thing that I just remembered we talked about, which I think is like, I would love someone to debate me on, is like, back in 2021, a lot of the ideas around investment clubs and kind of like, group investing was very focused on like social and like, something you do with your friends and whatever. And I think now maybe a place to start is not your immediate social graph, because like, it's hard for me to reason about like someone that I know and say, yeah, like I trust that guy with my money. You're really climbing a very local hill, and it's probably not the right hill to climb. And so I think like, back to this idea of like super forecasters and prediction markets, like you don't know them personally, right? It's not a social graph in terms of personal relationships. It's more like, an economic graph or an interest graph. Like I'm interested in what this guy's interested in. He's making money and I can see that. And that's like, I think that's probably where you want to invest in people that make money. And that's very different than a lot of the like, WAGMI projects in 2021, which were just much more like kind of, I would say social graph oriented.
Just to add to that briefly, Jesse, one of the things that I've heard you say a bunch that I really like is, when you have new platforms, especially when they're semi-social, you get new classes of celebrities or new influencers. So I think this is an example you've used verbatim, which is like YouTube didn't go to the Hollywood studios. They created new celebrities and sort of new creators. TikTok has entirely new creators. Prediction markets, they're not just exchanges. They're also sort of social platforms or in some way content platforms. And so it's pretty logical that you'll see a new set of influencers. And to your point, it'll be economic and people want to be able to invest in those influencers. And one way to do it is copy trade. Another way to do it may be allocate money. There may be many more ways to do it.
And yeah, I think, obviously for prediction markets, specifically like, the dominant players, Kalshi, Polymarket, they could lean in and build these features. Alternatively, there's some there's another platform that allows you to invest in people that are running multiple strategies across different venues and so on. So, that's, come tell me which it's going to be.